Hi, my name is Warren Dueck, and welcome to our webinar, Americans Retiring in Canada. I'm here with my colleague, Emily Yu, and we're both, hey Emily, and we're both based in Vancouver, and looking forward to talking about the subject. It's not for just people moving to Canada, Americans retiring to Canada, but some Americans have been living in Canada their whole lives long. And really the unique issue here is what changes when people retire is, their compensation may have no salary or wages they earn, but for the predominant part of their income may be investment income. And so we'll talk about some of the unique issues there. Now, we've had questions about people retiring to Canada from other countries as well, and many of the same topics be applicable to them, but our focus will be on particularly individuals that are U.S. citizens or U.S. persons, and those include people living in Canada with green cards, because green card holders are subject to U.S. tax on their worldwide income. And if you have questions about that, you're certainly welcome to follow up on that. We do have time for questions in the seminar, so please write in your questions and we'll address those at the end. And we've got some people that'll be going through those questions and asking Emily and I those. We'll also have a survey, and the survey will give you an opportunity to get some feedback from you. We're always interested in hearing your feedback, either questions you have as a result of the webinar, or also feedback on, boy, I'd really love you to address this topic. We can't address everything. And we're trying to focus these courses on what we call Tax 101. We don't try and get too deep on them. Otherwise, we'd be only talking to a few people that are interested in going really in depth. But we want to hit kind of a broad category that allows people to say, hey, I understand this, and maybe understand the question I can ask about. There's also live transcript, closed captioning available for you if you like. It's not perfect. That's probably more a criticism of me and Emily in terms of just when we say things that not everything comes through quite as clearly. We'll also, our agenda for today, we'll talk about investment income. That's probably the biggest single part of today's session, and we'll talk about a number of scenarios there. Canada pension plan and U.S. Social Security, some things that may surprise you that apply there. Registered retirement savings plans, and that includes both RSPs and RRIFs, or registered retirement income funds, tax-free savings accounts, employer pension plans, and then lastly, estate planning. And I'm going to hand it over to Emily, and she's going to start talking to us about investment income.
Thank you, Warren. Hello, everyone. I will start by looking at common types of income and address sourcing rules, how the income is taxed in Canada and the US, and also how foreign tax credit is used to avoid double taxation. As Warren mentioned, please keep in mind we're discussing general rules. There are often exceptions we may not specifically address during the webinar. And also on the US side, we're focusing only on the US federal income tax. Now, many of us have, as you understand the slide, certain type of income. How they're sourced determines often how they're taxed in each country. In terms of compensation, so employment and pension income, those are sourced to where the service is performed, whereas rent and royalties are sourced to the location of the property. Capital gains often are sourced to where the owner's country of residence. So if you're a US citizen living in Canada and you sold General Motors shares, even though this is a US corporation, the capital gain is generally sourced to Canada. So in this case, Canada would have the first right to tax that income, then US will provide a foreign tax credit. One exception is a real property and business asset. That's sourced based on the location of the property. So if you instead sold a house or a grocery store in Washington state, then the capital gain is considered US sourced. Well, both countries tax generally capital gains or certain types of capital gains favorably. The two countries tax them differently. So in the US, the distinction is how long you've held this asset. So if you held the asset for a year or longer, you would get a capital gain, a long-term capital gain treatment. So the tax rate is between 0 to 20%, and the maximum rate is 20%. Whereas if you have shorter capital gains, it's taxed similarly to ordinary income, which is up to 37%. Sorry, 37%. In Canada, we don't distinguish ownership period. However, Canada only tax 50% of net capital gains. So if you receive $100 of interest from Bank of Montreal, your Canadian tax liability could be as high as $53 if you live in BC. Whereas if you sold Bank of Montreal shares and realize $100 of capital gains, your maximum Canadian tax liability on that gain is about $27 if you live in BC again. Also, if you sold principal resident, there's some differences as well. The gain from principal resident is not subject to tax in Canada at all. Well, you do need to make a designation as such. And provided you made that designation, it's not taxable. US, on the other hand, would exempt up to $250,000 of gains per owner. This is US dollars. Also, if you moved to Canada recently, or you're thinking of moving to Canada, keep in mind that Canada does not tax pre-residency appreciation. If you have GM shares, you bought it for $10 and it's worth $40 when you come to Canada, your Canadian tax basis is $40. One exception, again, there's always exceptions. One exception is taxable Canadian property. So if you own a house when you move to Canada, that house in Canada does not get that step-up basis.
So Emily, that's a huge issue, this step up in tax basis. In other words, if a U.S. citizen comes to Canada, just to use your example of the GM shares,
right?
They bought them for $10, and let's say they sell them for $100. They're taxed on the $90 gain. But if they were worth $40 when they arrived in Canada, Canada only taxes the appreciation above this.
That's
now, this is actually a massive opportunity. The unfortunate thing, it doesn't really apply to U.S. citizens per se. U.S. citizens get the advantage of having only being taxed in Canada on the additional amount, but they're still paying U.S. tax on the full amount. So there's the win there is kind of muted. But if someone was not a citizen of the U.S., and there's some other provisions associated with green card holders, and they came to Canada, they would pay no tax at all on that pre-residency appreciation, because the U.S. doesn't tax it and Canada doesn't tax the amounts below the $40. So this is potentially a very significant tax opportunity for people with highly appreciated assets to come to Canada. Nobody thinks of this way, but Canada is a tax haven. You heard it here first. But this is really, there's significant dollars there.
That's right. A year of move a lot of times provides a tax planning opportunity. Now, another type of income I would like to look at is interest and dividend. There's some actually unique rules related to this. As it is, generally, the sourcing of interest and dividends is typically to the location of the payer. However, there are some interesting rules, and those rules are provided under the treaty. As what we indicated earlier, treaty provisions are usually there to provide protection from double taxation. And in the case of interest income, if you're a U.S. citizen living in Canada, if you get interest from the U.S., it's actually resourced to the country of your resident. So if you have $100 for a Bank of America interest, it's resourced to Canada, and Canada actually has the first right to tax this income, even though the payer is a U.S. source, it's based in the U.S. Dividend could also be resourced. There's a treaty provision that protects U.S. citizens from being subject to additional tax purely due to their U.S. citizenship. So using GM as example again, so if you have a dividend from GM, Canada will treat it as U.S. source and grant foreign tax credit, but it's only limited to 15%. So if your U.S. tax liability is more than 15%, you're not getting a full credit in Canada, and there's an element of double taxation. In this case, the U.S. will allow you to treat a portion of this dividend as a Canadian source. So the U.S. actually will allow foreign tax credit from Canada to reduce your U.S. tax liability to 15%. And as a result, you're in fact are getting a full foreign tax credit in Canada.
Now, this is one of the reasons why Albert Einstein said one of the things he could never understand in life is income taxation. And that's because some of the counterintuitive ideas here that suddenly that General Motors dividend for U.S. tax purposes is treated as it's arising in Canada, not in the U.S. But that provision under the Canada-U.S. tax treaty, as Emily said, is there to avoid double taxation. So there are some really critical things here, but they're definitely counterintuitive. I just want to raise a couple things here on, for example, the dividends. Now, I know we've got a lot of investment advisors that are on our webinar today, and so you'll be interested to know this. The tax on dividends from outside of Canada, the top marginal tax rate in Canada goes up the top marginal tax rate. For example, in BC is about 54%. It's very similar to Ontario. Alberta's a little lower. Depending where you're at will depend, but it goes up the top marginal rate. Whereas if that dividend it was an eligible dividend, and eligible dividends come from Canadian corporation, the top rate drops down to, for example, in BC to about 36.5%. Now, you should never do things strictly for tax purposes. And so the investment decision is always number one there. But there is a tax difference there. And as you look at your portfolio, that's one of the things you want to think about. One of the other issues I just wanted to raise from Emily's comments is about compensation, because many people, when they retire, that doesn't mean they stop working entirely. But maybe they work for a U.S. company and they're getting paid in U.S. dollars. They say, well, surely that must be U.S. source income. But as Emily said, it's where the services are performed. So if you're living in Canada and you're working at your laptop in your kitchen, even though you're being paid in U.S. dollars, even though it's paid by a U.S. company, it's Canadian source income. The U.S. does not get to tax it first. You should not have any Social Security taxes withheld in that income. There are some exceptions, but they're pretty limited. You shouldn't be subject to state income tax on that. So we see that lots, especially in today's world where people are working remotely. So compensation is sourced to where the services are performed. You should not have U.S. withholding tax on it. You should have Canadian withholding tax on that. Can you go to the next slide, Emily?
Yes, please.
Okay.
Now, we talked a lot about the foreign tax credit so far. We just want to touch on how the foreign tax credit worked in both countries. And foreign tax credit is generally fairly effective at minimizing double taxation. Now, in Canada, we have foreign tax brackets, but they're organized on a country-by-country basis. So this is which country the income and the tax liability arise. U.S., on the other hand, has basket, but they're organized by types of income and not by country by country. There are currently 7 different foreign tax baskets in the U.S. Most common ones are general limitation. This is where you would have your employment and pension income. Passive income is where you would have your investment income, and resourced income is where the Bank of America interest that actually arises from the U.S. but is resourced to Canada. Now, there's one type of a US tax that cannot be offset with foreign tax credit. This is net investment income tax. It is 3.8% of investment income, and you will be subject to this tax if your modified adjusted gross income for the year exceeds certain threshold. And for married filing joint taxpayers, the threshold is $250,000 US. Now, both countries, Canada and US, have international information disclosure requirements. The very common forms that are required by US citizens to be filed are what we indicated, RS Form 8938 and FinCEN Form 114. If you have bank accounts or specified asset outside the US, you would generally be required to file these. There's filing threshold associated with each form, but failure to file these forms when they're required to are subject to penalty. IRS currently has voluntary disclosure programs. If you believe that you have not filed some of the forms that you're required to file, please reach out to us. We'd be happy to help you become compliant. Canada also has disclosure forms as well. A very common one is the T1134. T1135. It also has a filing threshold, but if you're required to file, you're required to disclose bank accounts you have outside of Canada, investment asset. Exceptions from these form is vacation properties and also actually U.S. pension plans.
Emily, you mentioned just indirectly CRA form T1134 as well.
Sorry,
and of course,
that's true.
That is for Canadians that own interest directly or indirectly in non-Canadian entities. So a lot of Canadian tax in many respects parallels U.S. tax issues, but you have to be careful on that because, as I say, as close as the U.S. and Canada are to each other in many ways, in their tax law and a lot of other things, it's the differences that count here. So that's significant. I'll bounce over to the next slide here and talk specifically about Canadian investments. Of course, it's pretty common where people come to Canada that they'll invest in Canadian entities and investments in Canada. And again, we've got a broad range of investment advisors here too. And what are the U.S. tax implications associated with these? So I'm going to say there's kind of three categories of non-U.S. investments, and this is pursuant to U.S. tax law. One is something called controlled foreign corporations. Firstly, anything with a special name, you got to be careful of because you got to know there's special rules there. Basically, with the controlled foreign corporation regime, it's where there's more than 50% control, and that includes both direct and indirect. And that may include other family members. So it's quite a broad and complex scenario there associated with it. The other category is passive foreign investment company. We're going to talk about that, PFIC or PFIC. And again, there's special rules there. And then the last category I said is other. Other really is the best news you've heard today is it doesn't get any special treatment. So you want to fit in the other category, not in the first two generally, if only to minimize your tax compliance costs. So the controlled foreign corporations are generally going to be privately held corporations, but the rules still apply to public corporations. The U.S. doesn't make a distinction between publicly held and privately held. The only issue here is if there's more than 50% control. And that's control is either in voting control or control in terms of the value of the corporation. So you may have less than 50% control, but you own more than 50% of the value of the corporation, you'd be subject to these rules. Like I say, most of the time it involves private corporations, but it doesn't mean it couldn't be a public corporation and be a controlled foreign corporation. The key part about the controlled foreign corporation regime is the earnings in the corporation may be taxed directly to the U.S. shareholder. And so for example, and it tends to focus on what we'd refer to as passive investment income, interest income, dividend income, capital gains, things like that. And so if a U.S. person sets up a corporation in the Bahamas, puts $1 million in it and earns interest income, all that interest income is going to be taxable directly to the U.S. shareholder because it will qualify for this category. And there's basically two categories of earnings taxable to the U.S. shareholders. It's something called Subpart F income and GILTI. You don't have to know those terms. What you have to know is that if you have that passive income or that qualifying income there, it'd be taxable. Now, it's not always passive income, so you need to be conscious of that too. All this requires disclosure on IRS Form 5471. It's become one of the most complex forms, and I haven't counted the number of pages. I don't know if you know the answer to this question, Emily, but I think from beginning to end, I think it's like about 15 pages now. And this is one form.
Yeah, with all the schedules.
With all the schedules, yeah. So it's really kind of a heavy duty thing there in terms of fitting into the controlled foreign corporations. Like I say, generally private corporations, if a U.S. citizen comes to Canada, incorporates in Canada, generally it'll be a CFC in terms of a regular corporation or controlled foreign corporation. Now, the other category we talked about is passive foreign investment companies, or PFICs. And again, as our investment advisors know, this is a huge category because you look at all those types of PFICs are non-U.S. mutual funds, exchange traded funds, or ETFs. And I said, et cetera. Now, I want to warn you about the et cetera. I couldn't list all the ones, but these first two qualify quite easily, non-U.S. mutual funds and ETFs, because they're a non-U.S. corporation that meets one of these two tests. Either over 75% of the gross income is passive, or more than 50% of the average assets are passive. Just a little explanation here. I mean, and there's two parts to this. One is, if you're a mutual fund, all your income is passive income, so to speak. And all your assets are passive in that they would generate passive income. And that's passive is a term under the Internal Revenue Code. The tricky part here is you say, hey, well, I'm investing in this mutual fund, but it's not a corporation. It's a trust. Yeah, it is a trust under Canadian law, but the issue is, what is it under U.S. law? And all trusts that have business income that they're deriving, and a mutual fund, for example, its business is to generate this investment income, will be treated for U.S. tax purposes as a corporation. So there's some exceptions. They're fairly limited and they're very specific in that respect. But virtually every mutual fund you see on the market is going to be a passive foreign investment company. Now, I want to come back to that et cetera that I mentioned earlier here. And the point is this, is that corporations, you're going to say like a business corporation can also be a PFIC. So you have to be careful here. And what I'd say is this, is any business with a long earnings cycle, at least 2 years or over 2 years, to generate revenue has a good chance of being a passive foreign investment company. I'll give you an example here. A biotech company. It doesn't earn any income for the first 5 years of its life. But in order to research that opportunity, the cure for the common cold or whatever it is, they receive $10 million. They put in a bank account, and they slowly draw down that money over the 5 years to fund their activities. Well, they meet the first test. Their only income is interest income, and more than 75% of that is passive. They don't have any other source of income, so they're going to be a PFIC here. Now, there's some things you can do to solve those problems. They take someone paying attention to those issues. If you're not just biotech companies, tech companies generally, anything with a long earnings cycle, so like developing a mine, They're going to build $100 million mine in northern BC. It takes them 3 years to build the mine. They've got money earning interest income at the same time. Vineyards, same thing. It takes time for the vines to grow. I'm not a vineyardologist, but it takes a long time to generate that income. Cranberry farms can be the same situation. Anything with a long earnings cycle. Penny stocks are frequently PFICs, simply because they've got some moose pasture in northern Alberta or something like that, and they've got $10,000 in their bank account. Their only source of income. They're probably a PFIC. Now, okay, you're a PFIC. I remember I said anything with a special name you got to look out for. Well, the bad news is that PFICs aren't taxed, don't get capital gain treatment. They don't get qualified dividend treatment. So their tax rate's up to 37% versus 20%. There's an interest charge on deferred income. So you buy into the moose pasture in year 1 for $1, and by year 10, now it's worth $1 million. But U.S. tax law treats it that you earn $100,000 every year. You should have paid tax that income every year, and now you've got an interest charge on that. Now, at low interest rates, that wasn't a big deal, but as interest rates rise, this starts to become more important. There's a limit on availability of foreign tax credits. So PFICs can be dangerous entities. So what are the solutions? One is just don't invest in things that could be PFICs. Now, that may not be a very practical solution for a lot of reasons. One is that, if your client, or if you have $100,000 to invest, that's all your investment funds, putting them all in Walmart or in Apple or in Suncor or, other Canadian corporations, that doesn't give you any diversification. And that's why I say, make decisions based on investment criteria, not based on tax decisions. So, you want to think about this in a broader context. Avoiding PFICs may not be a practical answer. If you have $10 million to invest, you can probably achieve diversification without things like mutual funds or ETFs. Two of the solutions there are, one is the qualified electing fund election, and the other is the mark-to-market election. The big deal to get to the qualified electing fund election, or it's often referred to as the QEF election, is you've got to have your fund or the entity you're investing in has to provide you with an annual information statement based on U.S. tax law. And there's potential there for some adverse impacts. They tend to be fairly minor, but you have to be aware of it, that you may end up earning income for U.S. tax purposes, but not have it for Canadian tax purposes. The mark-to-market election is probably a more volatile choice because it forces you to recognize income in any year that the value of that investment increases. And this is only applicable for publicly traded entities. So the solutions aren't necessarily great, but it's not like they're not there, and every case may be unique in that respect. So we'll move to the next slide, and Emily, you're going to talk to us about CPP and FICA.
Thanks, Warren. Well, both Canada and the US have federal social security program. Canada, as we know, is Canada Pension Plan. In the US, we have social securities. Now, how each country gets taxes income is determined by the tax treaty between the two countries. So in the US, if this is a CPP or US Social Security paid to a Canadian resident, the US actually does not tax this income at all. On your US income tax return, you actually do need to disclose that you receive this income, but do not include them in your taxable income.
Now, this is another one that kind of surprises people, is that, what do you mean? I don't pay any US tax on the Social Security I receive from the US? I mean, that sounds counterintuitive, but that's what the law reads as.
Exactly. And on the Canadian side, CPP you receive as a Canadian tax resident is fully taxable in Canada. However, Canada would only tax 85% of US Social Securities So on the Canadian return, you would again disclose that you received 100% of US Social Securities, but you also get to take a deduction of 15%. So in effect, only 85% of the US Social Securities is taxable in Canada.
So, and the reverse is true here too. If a Canadian retires to the US and they receive Canada pension plan, they don't pay any Canadian tax on it. It's just US tax. So it's based in the country of residence.
Yeah, in Canada, there's no withholding from Canada either.
Yeah. Do you want me to go to the next slide?
Yes, please.
Okay.
So for US citizens who have lived or worked in Canada, they would often have RSP or RIF, Registered Retirement Savings Plan, and RIF. So in Canada, contributions are deductible, but distributions are fully taxable. Well, as we know, in the US, couples can split income by filing joint returns. Canadian taxpayers have very limited opportunities to split income with their spouse, but this is one of those. So for taxpayer over 65, if they receive RIF income, they can split RIF income and also actually most pension income with their spouse who's in the lower tax bracket. The maximum amount they can split is 50% of such income.
So this is a big win for Canadians, for Canadian residents. Yeah.
Absolutely. Make sure you do take advantage of it if you're receiving such income. RIF has annual minimum withdrawal rate, and this is determined based on the taxpayer's age. Now, on the US side, RSP income is considered Canadian source. Investment income that you realize inside RSP is tax deferred until it's distributed. Now, because US does not allow RSP contribution as deductions, you may actually have a US tax basis when you receive RIF income. Your basis is your contribution that you made over the years. So each year, as you receive RIF income, you have to take a look at it and determine how much of it constitute investment income you realize over the years and how much consists of a prior contribution. And that amount would change each year. So you have to determine that on an annual basis. Now, Warren mentioned PFIC. RSP actually protects you from PFIC regime. So if you plan to hold Canadian mutual funds, which actually includes money market and potentially some REIT, hold those in your RSP. RSPs and RIF are required to be disclosed to the US on those information disclosure forms. Can we have the next slide, please?
Yeah, just before we go that, on the US tax basis, so if a Canadian has $100,000 in their RSP and they withdraw it, a Canadian resident is going to pay full tax on that amount, the $100,000. But if they contributed $70,000 to that plan, now it's worth $100,000, they may only pay US tax on the $30,000, which is the total value of the plan minus the contributions they made. And that the one important exception here is that doesn't apply to basically employer plans. So if you have an RSP that is by your employer, you can't get that treatment. But if the plan is was started by yourself, not an employer plan, you'd get that result. So that's a significant win, particularly for Canadians that move to the US, because they'll get basis in their RSP for US tax purposes. And their tax in Canada when they withdraw from an RSP can be as low as 15%. So that's a big win for them.
Good point. So what's the takeaway here is that keep track of your contributions. So eventually, if it's individual RSP plan, that way you have support for your basis. Now, many of us have heard tax-free savings account and contribute to it. In Canada, investment income earned in a TFSA and country and distributions are not taxable at all. Right now, the annual contribution available for Canadian tax resident is $6,000 per year. It's not tax deductible. Now, if you plan to move away from Canada and cease to be a Canadian tax resident, please keep in mind that you do not make further contribution once you move away, because non-resident contribution is subject to penalty. Now, on the US side, US essentially treated TFSAs as Canadian bank or investment accounts. So there's no tax deferral on investment income earned within the TFSA. And so any investment you earn in TFSA is tax-free in Canada, taxable in the US. TFSA, unlike RSP, does not protect you from PFIC rules. But similarly to RSP, TFSA is required to be disclosed on those information disclosure forms. We get asked a lot by US persons that should I invest in a TFSA? I think our answer is generally yes, but you do have to make sure that it does not trigger an overall increase in your tax liability. It wouldn't make sense for you to have a TFSA if you're save Canadian tax, but you end up paying more US tax as a result. Now, how can you avoid this situation? You could achieve this by having sufficient foreign tax credit from other sources to offset US tax on the TFSA. So for example, if you have investment in non-registered account in Canada and you pay Canadian tax, you could use foreign tax credit from the investment in the non-registered accounts to offset US tax liability on the TFSA account.
So kind of a general rule there is if I put $50 into a TFSA, I should probably put $50 into a non-registered account. I mean, that's a very rough kind of analysis. But just putting money to a TFSA isn't by itself a good idea because any reduction in your Canadian tax may result in an equal increase in your US tax. Your goal is to get the lowest overall tax. Your goal, and why TFSAs are important is because typically your Canadian tax is up here and your US tax down here. You want to drive your Canadian tax down to the US tax, but you don't want to reduce your Canadian tax to increase your US tax so they offset each other. So exactly. That's a strategy that people can use. And, tax-free savings account, if you're paying most of your tax in Canada, are a way to reduce that. And we definitely recommend that in most cases that people use TFSAs. You ready for me to talk about retirement planning?
I am.
Okay. So we've got a couple topics here to finish. These, every one of the topics we talked about today, we could actually spend probably all day talking about. So, we're kind of hitting it at 30,000 feet, but we'll talk about U.S. retirement plans, which include, pensions, 401k plans, individual retirement accounts or IRAs. There's other plans as well. When income comes out of those plans, it's basically sourced to the place of employment. And for the U.S. retirement plans, will be taxed first in the U.S. Now, this is where it starts to get interesting here, because then they'll be taxable in Canada unless the income is not taxed in the U.S. So you should be scratching your head. I have these earphones on, or these headphones on, so I can't exactly do that quite as well, but saying, well, who fits in that category? So if you were not a U.S. citizen, but you worked for example, a U.S. company, and you did that work outside the U.S., but paid into a U.S. employment plan, the contributions you made to that U.S. plan may not be taxable when you withdraw that money. If it's not taxable in the U.S., either some or all of those monies, when it's brought back to Canada, it's not taxable in Canada too. So this could be a significant win for people. Typically, our experience this category are individuals who are not U.S. citizens, not U.S. green card holders, but have worked overseas for U.S. companies. And there's a longer discussion here in this part. But remember that in order to be taxable in Canada, it had to have been taxable in the U.S. On distribution from a U.S. retirement plan. There's foreign tax credits when you make the foreign tax. You can use the U.S. tax paid in that plan to offset your Canadian tax in the plan there too. Now, another question we get asked frequently is, should I transfer my U.S. 401k or individual retirement account to an RSP? Now, that becomes a very specific question, and frankly goes beyond, of course, this. But generally, I'd say this: we don't recommend you do that. Unless you've got an investment you can't make in that U.S. plan, but you could make it in a Canadian plan. Really, what most people are thinking about, it just feels like it's more convenient. But there's a cost to convenience. Firstly, when you pull those monies out of the U.S. plan, you'll pay a U.S. withholding tax on that amount. You, in certain cases, may be subject to an early withdrawal penalty as well. And you won't have as much money left in your RSP. And if you don't get full credits in Canada, you may end up in a worse situation. You have now less money to invest. So the real question is, why would you choose to do that? If it's only for the sake of convenience, that's a pretty costly convenience. Can it be done? It can be done, but the individual does not end up with 100% of the money they took out getting that in Canada, and they can actually end up in a lot worse situation as a result. So we do not generally encourage people to do that. There may be exceptional cases. I think larger amounts of money can be relevant if you have a net worth of over $12 million US. You'll be exposed to U.S. estate tax you wouldn't otherwise be. That would be another reason. But not very common. We recommend people transfer U.S. retirement plans into a registered retirement account in Canada. Estate planning, again, this is a huge topic by itself. Canada at death has a deemed disposition rule that says that any accrued gains are taxed in the year of death. If you're married, you can roll it over to a surviving spouse and effectively defer the tax. The interesting part about, and it's important for Canadians to realize this, because a lot of Canadians don't, is this is really basically an income tax at death or a capital gains tax at death. And, you can be taxed at rates up to, roughly about 27% on any unrealized gains in the year of death. Now, that doesn't sound very good. So, but in comparison, for example, U.S. estate tax applies not to the unrealized gain, but to the net value. In other words, if you've got $100,000 in a bank account and you die, let's make it $100 million, you pay no Canadian tax at death. But in the U.S., you could pay up to $40 million of tax if you had $100 million in a bank account. So it kind of identifies the difference. Now, Canada is an expensive tax place to live. I just said before is a tax haven to certain people, but generally it's a high tax country. But Canada is a cheap place to die. Now, you haven't seen that in any sort of advertising logo for the reasons that people aren't actually looking for a low-cost place to die. There may be exceptions there, but Canada is not an expensive place to die. The U.S. can be an expensive place to die. I'm not sure if that attracts you to Canada. I'm hoping that's not true. The second part is U.S. revocable trusts. And I say, are they Canadian residents? Generally, things like living trusts in the U.S. will be residents of Canada if the grantor or the trustees are Canadian tax residents. So if you established a a living trust while living in the U.S., or perhaps you're a Canadian that went down to a U.S. lawyer and they said, hey, all my clients have living trusts for their property. What you may be doing, because you're now a Canadian resident, or maybe always were a Canadian resident, the trust is resident in Canada. It has a tax obligation separate from its grantor. In most cases, revocable trusts will be called grantor trusts under U.S. tax law. All the earnings will be attributed to the individual. That's not true under Canadian law. And so living trusts can be problems. At a minimum, have a filing obligation. In a worse situation, result in additional tax. So be careful about U.S. revocable trusts if you're a resident of Canada, regardless of the fact that maybe formed in the U.S., regardless of the fact you may be a U.S. person. Those can all create problems for you. U.S. estate and gift tax, I said before, the top rate's 40%. There's an exemption. In 2022, the exemption is $12.06 million. I think that's slated to go up to about $12.9 million, and that's basically because of the inflation rate for 2023. But the important thing to note here is that it drops down to, it's going to be roughly, I'm going to say about $6 million. It'll be a little bit above that in 2026, because the current exemptions expire in 2026, and it reverts to some of the old law here. So you've got a big exemption now, but that doesn't last forever. And if you're a U.S. person, this is an opportunity to use gifting to reduce your U.S. estate. I've identified that below in terms of planning strategies. One of the key things I want to identify here is that if you're a U.S. citizen and your spouse is not a U.S. citizen, regardless of the fact of a green card, even if you live in the U.S., if your spouse is not a U.S. citizen, you cannot make a tax-free rollover to your spouse. You can under Canadian law, but you can't under U.S. law. Now, you can pass any amounts you want to your non-U.S. citizen spouse, but you'll still be subject to U.S. estate tax on death on that. And transfers to a non-U.S. citizen spouse would also be subject to U.S. gift tax rules too. So what are some of the planning strategies associated with U.S. gift tax? One of them is gifting. Gifting is a huge issue. Right now, U.S. persons can gift $16,000 annually to a recipient, and there's no limit on amounts associated with education and medical costs. So gifting is a way to reduce an individual's estate. And given the fact that in 2026, the exemption is going to reduce a significant amount, here's kind of a once-in-a-lifetime potential to make an even more substantial gift. Because if you gave a gift in 2022, you could gift up to actually just a little bit over $12.06 million in 2022 and pay no U.S. gift tax. Now, it would reduce your exemption down to zero, but you'd have already pushed those assets to other people, and especially if the assets have appreciation, there would be an opportunity there. If your spouse is a U.S. citizen, you're eligible for the unlimited marital deduction. So U.S. citizen spouses can transfer 100% of their estate on death to their U.S. citizen spouse. They can also make transfers during their lifetime as well. And portability is the term used that a husband and wife that are both U.S. citizens can increase their exemption from $12.06 million to $24.12 million. That portability provision allows the surviving spouse to access the portion of that was not used by one. So that's significant. But again, in 2026, it's going to reduce to a much less substantial amount. The last thing in terms of planning strategies is the potential to renounce U.S. citizenship. Now, again, this is a long subject. We devoted a single webinar to this. That was earlier in October, I believe, as I want to say a couple of weeks ago, that dealing with U.S. exit tax and renouncing U.S. citizenship. If you're able to do it without incurring other taxes, you're not subject to U.S. estate and gift tax. And that may have a very substantial value for you there. So again, this subject we talked about at length here. We're kind of hitting the high points, and we'd be glad to talk with you if there's other questions you have. On all these subjects, Emily mentioned that if you haven't made all the required filings, the IRS has some administrative policies to get you current. So there's opportunities to do that. We'd be glad to talk with you about that. We're going to go to the end of our session now, and that is questions. But do please complete the survey. How can we improve? We're interested in ways to do things better. If we're not coming across clearly, if there's subjects like us to cover, we'd be happy to do all that. We'll stay here for some questions, and thank you for joining us. If you're certainly not obligated to stay, but if you'd like to hear those questions, please do that. And Catherine, you've got some questions for us, I presume.
Yes, Warren. So can you distinguish between things that affect Americans versus Canadians who worked and lived in the US and want to retire back to Canada?
Well, I mean, Canada tax is based on residency, and the US tax is based on citizenship. So if an individual, a Canadian, went down to the US, but they were not a US citizen, and they've been able to abandon their green card, the only time they're subject to US tax is on US source income, now, which Emily covered talking about the source of income, which may include a pension plan or retirement plan. And so they'd be subject to US withholding tax on those amounts, and then be subject to Canadian tax on the full amounts.
Sure. Next, can a rental property in Canada be designated as a principal residence upon moving to Canada and into the property?
Emily, do you want to take that?
Yes, if so if somebody is moving to Canada and will not be using this as a rental property, then yes, if this person would be ordinarily living in this or primarily living in this property, then this property can be designated as their principal residence. There's a change of use rules that then this person needs to be aware of.
Sure. Next, I need to close out my RSP this calendar year. What might be the best option? Immediate income is not needed.
They want to close out their RSP?
Correct.
And what's the best option? I mean, if they close out their RSP, if they got $100,000 in their RSP, then all that $100,000 is subject to Canadian tax right away. Now, as we mentioned earlier, the U.S. tax may be the income for U.S. tax purposes may be something less than $100,000. But so I guess the question is, when you close out your RSP, if you don't need that income, and you could defer that income for some indefinite period of time, that would reduce the amount of income you pick up in each year. So unless there's a compelling reason to close it out, I'd probably be inclined to keep it around if you don't need the money, because it defers recognition of that income and payment of tax. Remember, we're tax people, so all we think about is tax.
Great. How do Social Security and CPP interact? Do payments from one limit the other?
Boy, do you want to answer that question, Emily? Or
well, most times they're independent from each other, but I believe there are circumstances where your social securities could be reduced when you have a CPP.
Yeah, that's fairly limited cases in that. I'm going to be at the point in time I retire. I worked in the U.S. for a number of years. I'm going to receive U.S. Social Security, but also receive Canada Pension Plan, and each covering their respective periods. So there's not an automatic reduction there, but it does occur in certain limited situations.
Great. So, is there any benefit to dual U.S. Canadian citizen renouncing U.S. citizenship when retiring to Canada?
Well, that's the $64,000 question. Here's the way I'd put it, and being a U.S. citizen and living outside the United States is expensive. Because if you're still living in Lincoln, Nebraska, or Seattle, Washington, or Los Angeles, California, your U.S. tax requirements may be fairly limited. You have to file a tax return, but there's typically relatively few disclosures required. But if you're living outside the United States, suddenly your tax return changes quite significantly in terms of not only the filings you must make. You've got to disclose foreign bank accounts, you got to disclose interest in non-U.S. corporations, partnerships. The list goes on and on and on. We just touched the surface of that. So the cost of your tax return is fairly expensive. You might not pay any U.S. tax, but the cost of actually filing your tax return is expensive. So in my mind, the real question is, there's a cost to being a U.S. citizen. Is the cost less than the benefit, or is it more than the benefit? If the cost of being a U.S. citizen is higher than any benefits you might derive from that, then I think maybe the idea of renunciation is not a bad idea. Remember, I'm a tax guy. I'm not talking about being patriotic or not patriotic, but I'm saying what's the best tax result here is, and in this case, it's not about necessarily the tax you pay, it's about the cost of complying with specifically U.S. tax law. And that can be substantial. The idea of renunciation does require a more complete analysis. Back in, it was after Forbes magazine ran a piece on U.S. citizens renouncing U.S. citizenship, that the U.S. brought in some renunciation laws, and that was with Bill Clinton. They've been worked up since then. There is some issues with U.S. persons renouncing, and what they want to do is avoid covered expatriate status. That was covered in an earlier webinar we did, and you're welcome to look back at that, or if you have a question I'd like to talk about it. I think renunciation of U.S. citizenship is a relevant issue. Is relevant. Let me make that clear. And but some people may choose not to pursue it, again, for entirely acceptable reasons. This is a personal decision that has some tax implications.
All right. One more question here. Could you explain the passive versus active and the PFIC rules?
Emily, do you want to take that one?
Passive, that's a big topic, actually, in terms of if we're looking at asset. So the passive is asset that either generate or it's held to generate passive income. So if you have an issue, then you're looking at a corporation, you're determining how much the asset and how much the revenue could be considered passive. I would actually encourage you to contact us. It's not necessarily most straightforward analysis.
But things like interest and dividends would be passive income,
That's right.
Unless you're in the business of lending money. Now,
that's right.
That's a fairly high threshold to get into that business. Making one loan doesn't put you in the business of lending money.
That's right.
But so interest and dividends would be one. One of the more interesting ones, I think, in this case is rental income. And So rental income can be active and it can be passive. And the difference typically here is that if rental income is managed by the owner of the corporation or its employees, it would be active income. But if it's managed by third parties, then it would be passive income. So, you know, as Emily said, this is not a very clear defining line. And passive income includes something that will, you know, you should probably do a double take on this one. Passive income could include services, professional services. And think about it this way: if you're if you're an entertainer, who's an entertainer? Michael Bublé's. I don't think he's a U.S. citizen. I think he's a Canadian citizen. So I used to use Frank Sinatra, but that seems a little bit dated now. What is my main? Taylor Swift. If you're Taylor Swift and you incorporate your activities, and particularly if Taylor Swift incorporated her service, she's a U.S. citizen and she's providing service, and she incorporates her services in a Canadian or other non-U.S. corporation. The service she provided will be something called foreign personal holding company. You don't have to remember that part, but it's going to be passive income for the purpose of this test. And again, they say, what? I mean, Taylor Swift's a performer, and but it is, by definition, it qualifies. So it prevents U.S. persons from hiding their income in foreign corporations. And in the case of Taylor Swift, it's something called a personal service contract. Because if you said, I'm going to hire Taylor Swift to come to my birthday party, and she said, and to sing, and she said, hey, I can't make it, but I know someone who's a really good singer, and his name is Warren Dueck. That does not cut it, because you're not going to pay me to sing at your birthday party. Well, you might pay me something, but you'd pay me a fraction of what you'd pay Taylor Swift. And so that ends up being a personal service contract. So for U.S. persons that have Canadian corporations and are providing their personal services from it, you have to ask the question, is that a personal service contract, which is foreign personal service holding company income, which is passive for the PFIC test? Again, that's a very convoluted thing. Emily told you the right answer at the beginning, saying that's probably something we should discuss. This is a big topic, but there are some convoluted things that even baffled Albert Einstein. So with that in mind, did you have anything that you wanted to add there, Emily?
Oh, I was going to bring it up that many of us hold what is called REIT, real estate income trust funds. For those, it's not always clear whether it's a PFIC or not. We actually have to look at individual ones to see whether there's an indication that that particular fund actually manages its own property. So it's not always clear. And if you're not sure whether a REIT is PFIC, maybe it's best not to hold it, just to avoid the PFIC rules.
Yeah, and with regards to a REIT, I mean, you'd look and say, well, they've got 5 buildings and 4 of them are managed by someone else. Those 4 buildings give you passive income, but the one building they manage themselves is not. And the question then is more than 75% of the gross rental income, is it passive or not?
Right.
A lot of sometimes the challenge is you don't have detailed information. You can't do a proper analysis. Yeah, well, it's challenging to get it. There's no question about that. And so you need to probably make some defensive choices there to protect yourself in adverse determinations.
That's right.
Hey, there is a lot on this subject that we could keep talking forever. And as much as we'd love it, I'm not sure how much of you would love it that we keep talking. But we like talking about tax. If you'd like to talk about any of these subjects, we'd be glad to do that. And Emily, thank you for working with me on this webinar, and thank you for being there, audience. We appreciate your comments and look forward to being with you again. Thanks very much.
Bye, everyone.